There has been a tremendous amount of volatility across markets globally in the recent past, and the reason is very obvious. It's because of the geopolitical tensions that are emanating from Ukraine and Russia. That continues to be the case even now. And this has prompted a lot of people to consider whether they should rebalance their portfolios between equity and debt. But there is also a mutual fund scheme that does this automatically. It shifts out of equity when there is a risk-off sentiment pervading, it shifts into debt, and then once the risk sentiment comes back, it shifts into equity. This is a balanced advantage or dynamic asset allocation fund. We'll talk about this in a lot more detail with our next guest. Shweta Jain of Investography is joining in. Shweta, thank you so much for taking the time. I've set the context, I hope, for this conversation. I'm hoping that you'll be able to explain to my viewers in a lot more detail how this works. If I were to ask you what a balanced advantage fund is and how it's different from the other types of hybrid funds, because there are so many, right? So how do you explain it? I believe that we may have a bit of an issue with Shweta's feed, but like I was saying, I'll wait till Shweta joins us back. Shweta, the question that I asked was, and I'm hoping that I've set the context for this chat, what is a balanced advantage fund and how is it different from the various other hybrid funds that are available in the market?
Hi, Alex. Thanks for having me. So balanced advantage funds is a unique category. In fact, hybrid funds, when you talk about them, we talk about them as a combination, right? Saying, okay, there is equity and there is debt, and up to, say, 60% equity or a 65% equity or 70%, depending on the fund house. So that much is equity and the rest is debt. But dynamic asset allocation or balanced advantage funds, as they're popularly known, they're quite interesting because they have the freedom to move towards either end of any asset class. So what I mean by that is, say, you could move towards, say, 100% equity almost, or you could move towards 100% debt, depending on what your views on the market are. So it gives the fund manager a lot more flexibility, but of course they have their own systems, whether it's market valuations, levels, PE, what they have as their parameters. So depending on those that are preset, the fund managers have the leeway to manage. So it's quite an interesting category, actually.
Explain how this works maybe a little bit more. As I understand it, and the way that you're pointing out, each fund house has different criteria that help them decide, okay, now the market is overvalued. I'm going to take money off the table from equities. I'm going to move it into debt. I'm going to be a little defensive. Is that how it works? Are there algorithms, for example, in some fund houses that tell them when to make the switch?
Exactly right. So when I say, the fund manager has the flexibility, it could be an algo based. For example, they could have their own parameters that they've sort of set, their own limits that they've set, and of course based on their views of whether they think it's a right time to buy, they think they need to wait for some more correction, whether it's time to sell. It depends on a lot of things that they have preset, right? For example, like one balanced advantage fund could now be entering into equity depending on how much cash they've liquidated some time back, or based on their future view. So even in balanced advantage funds, it isn't necessary that everybody, say for example, is now looking at the correction and is investing in it. There may be balanced advantage funds which are having liquidity pressure, and which may be actually selling off equity at this point of time as well. So it's an interesting category, like I said. So they have their own parameters, they have their own algos, they have their own systems that the fund managers have the leeway to work within, and of course their outlook on the markets, and considering today the various factors that are impacting the market.
Let's talk about the central thesis, though. Though these balanced advantage funds in and of themselves might operate slightly differently from their peers, the central theme and objective has to be the same, right? So
Yes.
how does that work? Where does it fit into an individual's investment thesis? Why would they want to go for a balanced advantage fund?
Okay, so a balanced advantage fund takes out the emotion from investing on the investor side, right? So, for example, I don't know whether I should be investing into debt, if I should be investing more into equity, but I do trust the fund house philosophy. I do know the fund manager performance, their philosophy. So, what I can do is say choose the balanced advantage fund and invest certain proportion of my money in that. At one point of time, it could be higher on equity as the markets are looking attractive, for example. So I don't have to take those calls because today it becomes very difficult as an investor. Should I enter the market? Should I wait? So I'm now sort of delegating this, so to speak, to the fund manager, saying, you take this call whether I should be higher on equity or should I be looking at protecting what I have already? Should I be looking at protecting my capital? So balanced advantage funds take out the asset allocation worry from the investor, and the fund house or the fund manager is doing this for us based on their outlook and based on their parameters. So I take out the emotion, I take out the discipline, because while it may look attractive to invest now, not a lot of people do have the courage, for want of a better word, to invest, because when markets are looking like there's blood on the street, it's really difficult to put in money at that time. Of course, investors are getting wiser, but it is still difficult for most investors to do that. So balanced advantage funds as a category take that headache from the investor and put that in the hands of the fund manager.
Okay. Another word is gumption and courage. There's this conversation about greed and fear. Perhaps that's one for another day. But let's talk about the tax aspect also, because that's something that is clearly a benefit when you're talking about balanced advantage. In a traditional sense, if I had, say, 60-40 allocation towards equity and debt, and if there's a crash in the equity markets and I have to book out and move from debt into equity, I'd have to worry about the tax aspect. Or on the other side, if equity moved to 80% allocation because markets soared, if I were to have to book capital gains, I'd have to worry about that tax aspect. So this is clearly another advantage, right?
Absolutely. I think tax and even say exit loads for that matter, if you've not completed the tenure that you've invested in for funds have exit loads and taxes are a big cost saver here. So if you have to rebalance, sometimes the costs sort of discourage us from rebalancing our portfolios. And there is enough research that says that if you rebalance your portfolio in a disciplined manner, you could actually be cutting out a lot of the risk, and you could be possibly increasing your returns even as high as the equity schemes themselves. Just to give you an example, or to build on your example itself, if you had started off with a 60-40 sort of ratio, 60 equity and 40 debt, and it moved to say 80 equity and 20 debt, clearly you're now overexposed to equity. So you have to cut down to 20. So there are two things. One, when markets have risen, you're actually doing the profit booking, staying true to your asset allocation. But at those times, honestly, tell me how many of us actually do that, because the greed does come into play and you don't want to cut equity at that point. In fact, if anything, when markets are rising or on the high, everybody wants to invest in equity, right? So I could possibly be increasing my exposure by investing more to 90. Whereas in a fund like this, if I have to cut down equity, it's automatically cutting down my equity. And, I'm staying true to my asset allocation and my risk profile. So I think that's another great reason, a couple of great reasons to invest in this category.
Here's the clincher that I'm looking for. Where does it fit in the overall scheme of things? Because I've heard it said, Shweta, that balanced advantage funds don't replace the need for asset allocation and rebalancing overall. So can it really form the core of your portfolio?
I think forming it as a core of your portfolio, I think is a little not realistic, I would say, for the simple reasons. At any point of time, I would then not know exactly what is there on my portfolio on a given date, right? So I don't know if I'm equity heavy or debt heavy. So the other part of my portfolio, I don't know what to do with that. Having said that, I think it can be sizable chunk of my portfolio. So if you have a core and satellite sort of approach to building a portfolio, it can't replace your core, but definitely be a strong satellite for that matter. So I think that is where it'll fit in. And for any and every investor, I think there is a little bit of a place for balanced advantage funds category, because you also know what's happening with the fund, at least at the end of the month when you're looking at it, or you're looking at what the fund is doing. You can actually, if you would like to sort of tweak your portfolio to that, you can actually do that as well.
One additional point, somebody looking to invest in these funds or these schemes from the perspective of getting regular cash flows, they should avoid this, right?
Oh, definitely. I think when it started off as a category, it was maybe sold as a fund that could give you regular dividends. But considering the nature of the fund, it is quite volatile. I would like to warn investors that as well. While it may not be as volatile as an equity fund, it is quite volatile in nature. It will not be like your debt fund where your capital is protected at all times, at most times. So I would warn investors of that. So definitely that's not a reason that you should invest, and cash flows is definitely not a reason that you should invest. There will be months where there will be no cash flow. I think if somebody's looking at cash flow, the best option is to invest in debt funds and do an SWP or a systematic withdrawal plan. I think that's the best option for investors to do.
Pleasure speaking with you, Shweta. I think you've explained balanced advantage funds in a way that everybody can understand. And I certainly found this chat insightful.
Thank you.